Welcome to our first mini lecture for Chapter 2. Before we begin, if you have not yet printed the items in the Please Print folder, please stop this mini lecture and do so now, because you will need these materials during each of the lectures. In this lecture, we will be using the document called Chapter 2 Essentials. In our last chapter, we learned about the financial reports or statements, which are the end product of the accounting information system. That would be the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. Why did we begin with the end? Because, believe it or not, the end product will help us learn the structure of the accounting information system. In Chapter 2, and then again in Chapter 3, we will learn how information gets into the accounting information system. Why is that necessary if we aren't going to be bookkeepers or accountants? Remember that the data the accounting information systems provides us through the financial statements is a very powerful decision-making tool, but if you don't understand the rules governing when and how that information is recorded and reported, then you really don't understand what you're reading in those financial reports or how business transactions will affect them. As managers, a full understanding of the accounting information system is essential. And understanding the first 3 chapters this semester is key to success both in this course and in business. So in this chapter, we will be learning how to record financial information that affects the balance sheet. Do you remember the balance sheet equation? It's the same as the accounting equation. Assets equal liabilities plus stockholders' equity. Let's go to the document called the Chapter 2 Essentials, Recording Transactions that Affect the Balance Sheet. And let's look at this definition of the word transactions. Transactions are business activities that have a direct effect on the assets, liabilities, or stockholders' equity of the business. When we begin a business, we need money to invest in buying property or equipment. In other words, assets that will be used in the business. We call those investing activities. If we have not yet begun operations, how can we get that money? Well, there's basically 2 ways. 2 ways of financing the purchase of those assets: through equity or through debt. Equity financing involves contributions of the owners. For a sole proprietorship or partnership, the partners or sole proprietor would be contributing money or other assets to the business. If it's a corporation, the corporation would be selling stock. The investors would be giving money to the corporation, and the corporation would be giving them stock in exchange. Another way of financing is through debt, and that's basically through borrowing money. So the company would get money from either equity or debt financing and then invest in purchasing assets that the business needs to run the business. Now let's look at common features of those types of transactions. First of all, companies always document their activities. In other words, there's a document that proves the transaction took place. So there's some type of documentation. We can't just make up numbers and put them into the financial statements. So some examples of documents might be checks, invoices, promissory notes, or stock certificates. The second feature is that every transaction involves a giving and receiving. There are at least 2 effects on the accounting equation. We call that the duality of effects. There's always a giving and a receiving. After every transaction is recorded, the accounting equation, assets equal liabilities plus stockholders' equity, stays in balance. And then finally, what do we record the purchase of assets at? We record them at their historical cash equivalent price, the amount paid for them on the date that the transaction occurs. This is very important. It's called the cost principle. Now, let's review what an account is from Chapter 1. We learned that an account is the format an organization uses to accumulate the dollar effects of transactions on each of the financial statement items. An easier way to remember it is that an account is a place to record increases and decreases in each asset, liability, and stockholders' equity item. So, for an example, there is an account called cash. And in that account, we record increases and decreases to cash, and we can determine the balance, or how much cash we have. There is an account for accounts payable. And accounts payable is used for purchases on credit. And in that account, we will have increases to the accounts payable account when we buy things on credit, and decreases to the accounts payable account when we pay off that debt. So every single asset, liability, and stockholders' equity item has their own account, their own place where we record increases and decreases. And if you want, you can pull out your balance sheet accounts document from this chapter, or your list of accounts from Chapter 1 to view examples of different types of accounts. Now we're going to dip a little bit into Learning Outcome 2-2 right now, so I can just give you an overview. There's basically 3 steps to getting information into our accounting records. The first thing we do is we analyze transactions. Remember, transactions are business activities that have a financial effect on the assets, liabilities, or stockholders' equity of a business. Not all business activities are transactions. So, for example, if someone calls you up on the phone and asks you the hours of your business operation, you would answer them and hang up the phone. That phone call did not affect the assets, liabilities, or stockholders' equity of the company. That would not be a transaction. If you hired someone for the business, but they have not yet worked for you or earned any money from their labor, then that's a business activity but would not yet be a transaction. A transaction has a monetary or financial effect on the assets, liabilities, or stockholders' equity of a business. So, the first step is to analyze the transaction. What accounts are affected? Are they increasing or decreasing? And what type of accounts are they? Then we record the transaction. We call that journalizing the transaction, and we'll learn how to do that in our next mini lecture. And then thirdly, we copy information from the journal into the accounts, the ledger accounts. We call that posting. Those are the 3 steps to get the information into our accounting records. Now let's just take a look at how what we're learning in this chapter affects the accounting cycle. And here's the accounting cycle. The business transaction takes place. We then analyze it to see what accounts are affected. Are they increasing or decreasing? We record that transaction. That means journalizing it, and we'll learn how to do that in the next mini lecture. And we copy that information into our ledger accounts. We will also learn that in our next mini lecture. All of those things take place on a daily basis. The transaction, the analyzing, the journalizing, and the posting. And then at the end of the month, we'll learn how to do a trial balance and our financial reports. So that's it for this lecture. There are no problems yet, so you can go on to the next mini lecture.